Alrighty, everybody, it's Ignatius L. Jackson, CPA, and welcome to the CPA Huddle. I got my wonderful co-host, Eric Pierre, CPA, here with me. Say hello, Eric.
What's up? I'm saying hello from Beverly Hills. I would play the Beverly Hills Cop song, but that could get us in trouble, so I won't.
Look at you with your white microphone today. I guess you got one for your travel trips now, huh?
Yeah, I forgot to bring my mic. And so I want to give a shout out to Randall Novak. You know, his son Travis had a 9th birthday. I was in Houston, and I checked my bag. I was looking for my mic. It's like, oh shoot, I gotta have this. So I stopped at a Best Buy, grabbed it. That was the ones available. I wasn't trying to. I actually prefer black because it doesn't get dirty. So that's why I have a white mic. So
there you go. There you go. All right, everyone. So today's topic, we're here with a special guest. This guy is amazing, Mr. Matt Sorensen from Directed IRA. He's the CEO of Directed IRA, great firm for self-directing your retirement accounts. And so highly recommend them if you're looking for somewhere to get into the self-directed game. All that being said, he is also an attorney, and he's a partner in a law firm called KKOS Lawyers. And so just a phenomenal guy, and we're happy to have him on the podcast with us today. So I don't know, Matt, if you want to introduce yourself a little bit to the crew.
Of course, yeah. Well, man, I love the Beverly Hills Cop music. I mean, that was a classic movie. That needs to be rewatched. I gotta watch that again.
I always watch it at least once a month, man. Seriously, it's awesome.
Once a month? That's a little much, Eric.
There's I work strange hours. You know that.
Love that show. So I'm an attorney. You know, like Ignatius said, I've been doing it. I can't believe it, since 2004. Seems so long ago, but and that's KKOS Lawyers. My partner Mark J. Kohler, many of you may know him, CPA also. I'm just, tax lawyer, but I kind of got into the self-directed IRA space. Then we started a trust company, Directed IRA. That's really my baby, and I'm kind of running that day to day. Have a team of about 40 people. We just passed $1 billion in assets under administration. Yeah, the billion. We hit the billion mark. That's when you know you're legit in our industry.
Yeah,
we did I'd agree. Yeah, in under 4 years. It's been about 3.5 years when we hit that. So, so I mean, I'm just like trying to help people save taxes, plan effectively, invest their retirement account and stuff they actually care about and get excited about, and that they can make better returns on. So that's me. I wrote a book also too, the Self-Directed IRA Handbook. That's what a lot of people know me, at least in the industry, on. It's the #1 book in the space. Regulators use my book. The association in the self-directed IRA industry uses my book. My competitors buy my book in bulk to give their employees in training. It really has turned into like the source. I know that's the best. I was like, should I let them buy this from me, or should I'm like, they can just buy on Amazon anyways. So,
well, imitation is the highest form of flattery. I know this. And I have.
I was just looking for my copy. I know it's in my office somewhere. I don't know where it's at.
I was about to say, like, I saw you had an autograph. I'm surprised you don't have an autograph poster. You guys have, I see you guys going to Phoenix Suns games together. I've actually been to a game with Ignatius, so I know where you sat. Good seats.
Yeah, it's a good spot. And we won, it's a great time being a Suns fan. When I first moved to Phoenix, it was tough. Being a Suns fan was tough.
Oh, yeah.
But we're starting to hit our stride. It's been good.
Yeah, for sure. Well, awesome. Thanks for joining us. Great to have you here. I know, Eric, you wanted to ask a couple of questions to Matt, if you want to kick it off.
Yeah. So Matt, thanks for coming on our program. We've met before. How did you find out about having a self-directed IRA? Because this is something that even to this day is not talked about a lot. Yeah. And I have clients that when I tell them this, it just boom. They're like, what did you just tell me?
Yeah. And you think, I mean, sometimes I don't blame clients for not knowing about it, but even us, attorneys, CPAs, like, we don't know about it, like, I didn't learn it in school. It wasn't on the bar exam. It's not on the CPA exam.
Nope.
Financial advisors don't know it. Like, everyone who trains them is like, don't teach them this, you know? So
for obvious reason.
yeah. So here, I found out about it. Now, Mark, my partner, you know, we have a law firm. We've been 50-50 partners for a long time, since 2008. But he had helped some clients and was doing a little bit of that, helping clients use IRAs to buy real estate. And it was kind of a small piece of what he was doing, but I was like fascinated by it because I'd never heard of it. And so what happened was I just started helping clients that were mostly wanting to do real estate deals with an IRA. And they were mostly real estate investors, real estate developers, contractors, people who just understood how to make money doing real estate, that they had no concept of what the heck a mutual fund even was or what stock they should be buying. Yet they had hundreds of thousands of dollars invested in this stuff in their retirement accounts. So for them, it was like totally empowering because, wait, I can use this, my retirement account dollars that I'm totally bored with, that I just click some buttons to invest in, that I don't even know what it's invested in. I just get a piece of paper in the mail every quarter saying whether it's gone up or down. You mean I could actually be involved in this, make a decision, find a property, do a deal, and save taxes? I mean, it was like sign me up, you know? And so what I had was I had my first big client, and this is what turned on for me, that I'm like, this is just going to be my thing. He was a real estate developer, and there was a piece of land that was like up against the freeway. This was agricultural land. He had $10,000 in a Roth IRA. Now this client, this property was probably worth like 350 grand. And so he went and made an offer to the farmer that owned it and said, hey, this is, you know, I want to buy 10 acres of this, you know, land, and I'm going to pay you 450 grand for it. But I just want an option to buy. I'm not going to necessarily buy it, but within the next 5 years, you got to sell it to me for 450 grand. So we bought an option. He gave the farmer $10,000 from his Roth IRA. And now his Roth IRA had the right to buy it for 450 in 5 years. Now, what my client knew as a real estate developer was that the county and state were planning a freeway exit right there. Yeah. And so
that was
2 to 3 years later, this freeway exit comes in. Now this agricultural property is highway commercial. There's a service station, a subway, you know, whatever, the usual stuff's like going in. And so, but my client didn't develop this. He was a developer. He just sold it to another developer friend of his for like I think it was he made over $1 million profit on it. He sold it for about 1.5 or so. And so he has $1 million coming back into his Roth IRA. It took a few years, but a $10,000 Roth IRA investment, he gets over $1 million profit back into his Roth IRA. Now for this client, the big surprise for me was, I remember because I'd kind of worked a little bit more in the space. I was doing more and more by the time this guy came back to me and he was closing out this deal. But I remember how pissed off, he was like pissed off. And I'm like, dude, we should be high-fiving right now. How are you mad? And he was like, I'm mad that no one told me about this before. He's like, I have a financial advisor. I have the big law firm. I have the big 5 accounting firm that does my taxes. No one told me about this. Yeah. They knew I make millions every year personally doing real estate. And they're all telling me to put money in these retirement accounts to go buy mutual funds. He's like, that's idiotic. So he's like, so he was just like really mad about it. And it was kind of like a wake up call to me. It's like, there's a lot of people out there like this guy probably.
Yeah.
That's it. That's how I got into it. And then I'm like, I need to write a book about it. So.
No, there's a ton of people out there like that. You know, people, like you said, advisors and CPAs, they either don't want to talk about it, or they're afraid of it, or they just don't know about it. You know, those are kind of 3 reasons that I think are there.
I agree.
And it's just crazy. You know, I think that a lot of us are aware of it, but I think a lot of us are afraid of it because they think something might happen, the client's going to screw it up, so they just don't even talk about it.
And then the ones that do talk about it, you know, on tax Twitter, some of them don't talk about it intelligently and say it, and so that's why I think a lot of us are scared to talk about, because I know. And I mean, like I said, I know strategies like that, and I know other ones I know about. I won't talk about on Twitter. I'll talk about them in conferences. I'll talk about them one-on-one client, but I don't I don't like putting them out there like that because it's just a slippery, in my opinion, slippery slope. But you and Mark
Yeah.
have mastered it beautifully and how you
Yeah.
disseminate that message.
Yeah. And I think one of the things is any, CPAs, attorneys, financial advisors, any professional that's kind of advising someone on how to self-direct and be like, yeah, you can buy real estate with an IRA. You can invest in a startup with an IRA. You can buy crypto with an IRA, like all these cool things, that are really, people are like, wow, I'd love to do that. But there are some rules to it. And I think if you're a professional, you don't know the rules, you start looking dumb really fast. So you just kind of make it confusing to your client. Like, yeah, it's just risky, and I've been on so many calls with other professionals over the years. And this is like big law firms, big CPA firms, like places you think that have a specialist within their big organization.
Yeah.
And like, this is the guy that does the retirement account stuff at this place. And they're like, kind of fuzzy on it. And so they kind of crap on it. And so that doesn't give someone a lot of confidence to be like, well, okay, I'm going to send $300,000 from my IRA to go do this. If, I'm not feeling a lot of confidence out of what anybody's telling me.
Yeah.
So that's why I tried to write the book. For one, is I want to like flesh it out and be like, this is what you can and can't do, and there's 150 citations in my book. I'm not just like,
Right.
some guru just throwing out dumb ideas to try and sell you something. I'm like, this is what you can and can't do. And here's the case why you can do it. Here's the case why you can't. And there's a lot of stuff that's like, I wish you could do it, but you can't. And here's the reason why. So I think it's education. People just need to get educated on it, because the internet though has so much more information. I think it's grown in popularity the last 10 to 15 years.
Yeah.
But there's risks, because there's people who like the tax Twitter. Like there's a lot of people that don't know what the hell they're doing. And that's the most dangerous thing, is someone who knows a little bit, but really knows nothing. And they start telling you what you can do, like they know everything. And these people come over here all screwed up.
TikTok even worse, because tax Twitter, Nation, that we have friends in there that actually know what they're doing in certain areas. Dan Choden, for instance, he's, I'm in the ERC space, but I consider him he's a little more doom and gloom, but I consider him the godfather, because he knows it inside out. And I'll say it again. I talk with Dan DM. I've actually shown his newsletters on that subject to my team over at our legal company is actually the expert group. We go by the ERC group.
Yeah.
And I always share it with them periodically to make sure guys like him, you're not really involved in tax Twitter. I wish Mark was, but I think Mark would probably whoop their ass too much. I think he's too nice.
Yeah, I gotta get Mark's got his social team, that's so which I'm starting to get too. It's a little tricky, but
yeah,
I think I don't know. I think that what I always tell people when they're like, okay, I've heard about this, but how do I do it? And I don't want to overcomplicate it for people. So I try to explain it like self-directing your IRA is like playing a board game. It's not that it's super complicated. It's just, you got to know the rules before you start rolling the dice, or you got to play with someone who's really done it before and knows what they're doing. So that's why I have my book, in the sense that is like, okay, this is the rule book on what you can and can't do, or get with some other professional, whether it's a CPA, attorney, advisor, that's actually done it for like 10 clients or 100 clients. Like they have a little bit of experience in it, so they're not cutting their teeth on your deal, and that's how you learn. But then what happens is, and this is with our clients, we have 10,000 plus accounts at Directed IRA already. And what we like for our clients, I always tell them, it's like, once you learn how to do what you're wanting to do, it's the same thing over and over again. Most people are just, they invest in something, they know something, they just keep doing the same thing over. They're either a rental person, they flip property, they're private money lender. They just need to know the rules on how to do that, and then just keep doing that over and over and over again.
Yeah.
No, that's exactly right. And I will say the citations that you have in your book, I think, is one of the reasons why I like it the most. I've read a few different books on and articles and guides and stuff in this area, and I really do like all the citations that you have in that book. So highly encourage people, if you are at all interested in doing this, go out and buy that book or read it. I'm actually thinking about maybe even giving a book copy of the book to all my clients this year as a gift. So
Oh,
you
what a great gift.
might be getting an order from me.
I need to
I'll
order.
hook
I
you
need
up.
to order. I need to order a copy myself. I mean, I've been to, how many of your events been to, Matt? 3 now? 2,
Okay.
3?
Yeah.
I think so.
Dude, you don't have a copy yet? I mean, I just got to give you
No.
one. I bring,
Okay.
I bring them. So
Well, okay. Yeah. Next time I
you,
see you, I'd like an autographed copy.
all right, signed copy
Because
coming your way.
yeah, because I end up working with 2 types of people now. My high net worth clients, they're not eligible to mess with the Roth, and I
Yeah.
usually use
They
a
could do
different.
backdoor Roth maybe, or they
Yeah,
could convert to Roth. So don't count them out, because they're some of the ones that love it the most.
you
Yeah.
can still. Oh, that's right. They did not take
The
the
Roth
backdoor. I
accounts.
remember they were trying to take that out. They did not
Yes.
take it out. Okay.
They didn't.
Yeah, that's still there. There's no cap on
Fact-
accounts, like what they're trying to do with
Oh, there's
Peter
no
Thiel
cap.
stuff.
Okay, because in fact, I
Yeah.
may need to do that myself because I'm having a very high earning year. I may need to consult with you guys later this year.
Yeah.
Because I do have an account with you guys. I haven't funded it yet, but there's a reason for that. It's not I don't want to do it, but there's a reason.
But you can do a backdoor Roth. So like what I do for high net worth clients is I always focus on the Roth account, because they pay a crap ton in tax and they hate it, you know. And
Yeah.
I'm always looking for a strategy on how to keep making money but not pay so much tax. And the Roth account is one of the best deals because it's tax free. So what we try to tell our clients is stop making money. And clients like, what? I'm like, stop you making money. Start making money in your Roth. It grows and comes out totally tax-free. It's like that real estate developer client I told you at the beginning, totally high income.
Yeah.
He converted to Roth. He actually had a really down year when the real estate market collapsed. But you know, he was able to get Roth dollars. And for him, it was like, wait, there's a way I know how to make money. He's like, you know, I know how to make money. I just got to choose the right vehicle to make money in. Do I want to use my S Corp or my personal stuff, my LLC? No, I want to use my Roth IRA. And it doesn't work for every deal. It doesn't work for an operating business necessarily, but for a real estate investor like him, it was like, psh, I mean, you know, he made $1 million in that thing on a $10,000 investment. If he did that personally, he was like, I would have kept half of it by the time I paid federal and state tax.
Yeah.
Because he's a developer, you know? So I actually love it for the high net worth clients, but they're always focused on the Roth.
And I think you have a really good point there. And I have a lot of conversations with my clients about that as well. I say the same thing, like you're making too much money in high tax situations. So you start shifting your focus.
That's my problem for next couple of years. The ERC is not operating business. I can't.
Yeah. You couldn't run it out of your own business. It has to be like an investment asset. And so it's kind of sometimes like, you know, it doesn't work for everyone. Real estate clients, it works really well for, because, you know, they always have a new deal, a new property. It's different from what they're doing over here personally, if they already got a current deal going, but they got a new deal coming down the pipeline. People want to invest in startups too. I mean, I have a lot of high net worth clients with Roth IRAs that love investing in startups that they think are going to like go to the moon. And some of them do. I mean, some of them crash and burn. But like we've had a lot of them that have like gone public while they've been here, and we've only been around for a few years, that have gotten bought out already, and they've had some big returns in their accounts. But those are people that are like in that space, like they're always sourcing and looking at those deals.
I'm actually trying to facilitate one of those deals right now. I'm involved in a private equity on a startup that if we can change hands, it would take off, and I would actually get 2.5%.
Yeah.
But we just haven't been able to find the right buyer yet. But once that happens, I will find myself in that situation. But
see, and that's
NDA,
like,
I can't say what it is. I'm under NDA right now.
Yeah. So, but that, like those examples are, okay, well, if that venture that you were, you know, involved in needed some money, and they're like, all right, we need some angel money just to get this thing off the ground before we go raise more capital, or we're trying to position for private equity, then put it in with your Roth. Like, you know, if it's early angel money and you're getting really high value for it, it's risky, of course, do it with your Roth account. And I mean, that's like the Peter Thiel thing, right? Like Peter Thiel is the first outside investor in Facebook. It wasn't making money, but he saw the promise of it. You know, now he's got the 6 billion Roth IRA. So but that's what he did. I mean, he was kind of made his money in Silicon Valley, and he would see deals like this. And so that's like, I'm always like, just invest in what you know. And I also think too, and this is why I love self-directing, is I don't think like really good investments aren't just laying around, and they're not sold either. Like no one's going to come to you really with the best investment opportunity and sell it to you. Really good investments are found or designed and created. Like the clients I see that really make money, they go find something no one else is looking for. Whether it's a real estate deal, a business opportunity, something that's undervalued significantly. Like they go out and find it and see where the value can be, or they make it. I think the real estate client, like my client that saw this piece of raw land on the highway, and he's like, I know there's gonna be money to be made here. How do I use my Roth? And that's where great investments happen, is like they're like found or they're like designed and created. And that's what you can do with self-directing, which you can't do with your IRA at Fidelity. They're like, here's your menu, the NASDAQ, the New York Stock Exchange, XYZ mutual fund.
So target retirement fund. Yeah.
Oh yeah. Like, how old are you? Well, I'm 40. Well, here's the fund you should buy. I mean, what even is it?
Yeah.
I even looked at one. I had one that I looked at, and I remember it was like 20% international stocks. I'm like, I don't want to be 20% invested in international stocks. And what even ones are they? Hell, I have no idea what they are.
Yeah.
What could be making toilets in Belize or something? I don't know. Or like, is that the venture that I think is going to really go? I don't know. So I think people just got lazy with their money, They're like, well, I just push a button, and Wall Street loves it, of course. Love it, right? They want you to be lazy with their money and not look at it.
Now, I got a question. When we were talking about operating businesses. Now, I've heard, actually know a little bit, but I want your opinion.
Yeah.
For instance, if you have business where the income is contingent, such as a personal injury attorney, comes to mind because Better Call Saul's last episode's tonight.
Oh, okay. I'm behind on it. Don't spoil it for me.
I'm not.
I haven't gotten to the last season yet.
But it's been on my mind because of that show.
Yeah.
Can you actually arrange for contingent income where the outcome is not guaranteed, to put that or a piece of that in a Roth?
You could. I'm just trying to think of some of the examples of deals. The first thing keep in mind is the retirement account, whether it's an IRA, Roth IRA, solo 401k, whatever you want to self-direct, it has to make an investment of money, right? Because that's all retirement accounts can do. They can only invest money. They can't do work or put in services.
Right.
They can just invest money. So, I mean, there's a couple of different things that come to mind. First of all, there's something called safe agreements that are pretty popular. Like we probably fund 3 or 4 of those a day. And safe agreements are kind of a startup venture capital model of funding where you basically lend debt. And so your owed back money is debt, but you have the right to convert it to shares. So it's contingent on the owner to say, you know what, I want to go to equity now. And it's a nice model because you don't really convert to equity unless the company really starts to take off. But then you have the right to do it at a super valuable valuation. So it keeps the business model really simple, and it does become very popular in Silicon Valley, like these safe agreements. I don't know, it's like contingent, but it's kind of has some optionality to it that the investor gets to control, to say, nah, I just want to stay debt, or no, I want to convert to equity. Sometimes it's called a convertible note too.
I'm familiar with convertible notes.
Yeah. Or a warrant. So like those are things that give you some like option of a big payday. It's interesting on just like lawyer contingency fees. There are firms that finance those big contingency fee cases, like if there's really big ones. So let's say they're usually not like injury, they're usually like mass tort things, or they're like huge company litigation stuff where the lawyers are working on a contingency basis, either entirely or in part. And so there are firms that'll fund those legal costs, and they get a piece of the award if they win. And so I have had IRAs invest in those firms. And there's a number of like just hedge funds or, basically like investment funds that finance those types of deals. I actually have a client of mine that does it on a small scale, which is personal injury, like auto accident stuff,
Yeah.
to other lawyers. And so and I've had some people's IRAs invest in that. So you could, that's the thing that's out there. You see everything with self-directing. You can, as long as it's a legit investment of money, you're not doing it with yourself or your own business. You can't buy collectible items. Those are restricted, but it's a pretty wide array of what you can buy.
So I can't go get that Honus Wagner card. Dang it.
No, you can't. Yeah, you can't get the collectible car doesn't work either. You used to be able to buy that stuff, You used to be able to buy that stuff.
I would love to do that, invest in a vintage Mercedes. Oh man.
That'd be cool. You just can't do it with an IRA.
You would use
man, that breaks my heart, man. I was looking at some old school Mercedes, man. You just hurt my feelings.
I know.
I appreciate you telling me the
it's
truth.
not mine. I'm just, don't blame me.
But I appreciate you telling me the truth because I saw a video of a CPA that said that you can take your profits from LLC, put it in life insurance, and have it tax free. I saw this video.
Yeah.
I'm laughing so hard.
We should probably do. I've always thought about doing like dumb stuff like that you see on social that people give advice on, and just be like, tell people why it's so dumb and wrong.
I have a clip I should send you if you want to do that. Let me know. I have one of a guy I know. I'm not going to say his name, but it's out there. But he told people that you could actually, have high income to do a loan, and then after you get the asset, get all your write-offs, and then get the asset and all the write-offs, except that's called bank fraud, which is why President Trump is having the problems he's having right now. Now, President Trump, I know you Trump fans, before you get mad, I know he's not the only one that's done this, but it is a federal crime to do that.
Yeah.
It is without the bank's consent to amend your return, that's a federal crime.
Yeah. So
and I've seen the CPA tell people to do it. I have the clip saved.
Yeah, that's just dumb as a CPA. Not only a CPA would tell a client to do that privately, but to put it out there.
Yeah, that's pretty crazy.
Yeah.
So, so you brought up earlier Peter Thiel, and there was a huge story that came out in ProPublica, however the heck you say that name. I can't stand
garbage.
That yeah, garbage. There we go. That's the
garbage.
for ProPublica.
That's a better word for it.
So
they even did race baiting with the article they did on Ballmer and LeBron. It's like, they have two different types of businesses. That's why their income's tax is a little different, you idiots.
Yeah.
But whatever.
So in regards to the article, you would think that maybe these types of accounts maybe gained in popularity. I'm just curious to know from your perspective if you guys have kind of seen any sort of an increase from that, or if you've kind of heard any sort of feedback from people that have maybe read that article and now they're thinking about getting involved in self-directing. And then a second kind of part of the question would be, why do you think that it's not as widely accepted, by people as something to do? Because even when I talk about it to people, they're not always convinced at doing it, and they're always a little gun shy about it. So what do you think we could do to increase the number of people that are doing this kind of thing?
It's a good question. Well, one, I think Peter Thiel, that article and all that media that it got did get people interested. I definitely saw that. It was a lot of like high income, highly educated people, I have to say, that were kind of like, wait, this smart tech billionaires doing it, maybe I should be doing the same thing crowd. It wasn't the general public that was like following that news story at all. It really, it just like, it wasn't on Fox News for more than a day or two. It just wasn't it's not on the Washington Post. CNN's not talking about it for more than a day or two. And so it just didn't hit the general public, but the high income people and the highly educated that are looking for tax strategy, it almost kind of legitimized it, because it's like, wait a second, he's doing it? That guy's super smart, like really smart, obviously very well respected, at least, from a business standpoint. And, you know, I know a lot of people disagree with his politics, but whatever. I mean, he's like, you got to respect the dude in terms of like investments and the business
Oh, you talk about Peter?
background. Yeah, Peter. Yeah, Peter.
Yeah. I respect his business acumen. Yeah, absolutely.
Yeah. So like he's done a lot. He's made a lot of money, obviously. He's put some points on the board for sure. So, but what was bigger than that actually was crypto. I mean, crypto came and so many people wanted to buy it, and they want to buy it in the most tax efficient manner. People want to do it with Roth accounts. That was a bigger thing. And what I learned from that really is, and this is something I kind of known for a long time though, is like, in order to self-direct, people need an investment that's attainable and easy to do. So
Yeah.
a lot of people, we'll get a lot of people that are sold on self-directing, and they'll open up an account here and then they'll close it in 6 months because they're like, well, I didn't find a deal, you know? And it's like, well, what were you thinking you were going to invest in? They're like, well, I don't know, like maybe real estate or maybe some startup or some private fund. And then they just never found it. You know, when you have like your IRA at a brokerage account, I think a lot of people are the same. They open an account, they drop some money, and they're like, what am I going to buy? And at the end of the day, there's like something they'll buy, you know, it's like, Apple, you know, or they're like, S&P 500, like they'll just like eventually like default to something. But with self-directing, you have to have something to invest in. And that's why we try to target groups that have investments or people that already invest in that stuff personally, because then it's easier for them to find deals. So I think it'll grow in popularity as alternative assets become easier. And there's a lot of, you know, alternative assets, quote unquote, you know, non-publicly traded stuff, basically, you know, that's growing in popularity. Just the average American's allocation to it keeps growing and growing every year, which means self-directed IRAs will grow and grow every year.
I agree. Yeah, I think one of the areas that is still kind of new, but I think to your point gives the opportunity to do some of that self-directing would be crowdfunding type portals, regulation A, regulation CF, those types of fundraisers. I know I've invested in several of those over the years that I've had my self-directed accounts, and they've been very, very fruitful. More so fruitful than the stuff that I'm doing in the everyday stock market, to be perfectly honest. So I definitely think, you know, as that grows in popularity, I think like you said, now it's a smaller bucket, or it's easier to kind of find that deal. You know, you might have some more people getting interested. So that's good.
Yeah, absolutely. And we've seen that for sure. So I think crowdfunding, when it came out, I mean, this is during the Obama administration when like regulation CF came out. That seems so long ago, but like I knew that was going to be a game changer. It took the SEC like 2 or 3 years to freaking write the rules on it after the law passed, I remember. So we're still like in the first 5 to 10 years of that. And I think like all the crowdfunding, what do they call them? Crowdfunding portals, you know, they're still kind of building. And regulation A, Reg A is going to be big. There's a lot of people out, you know, like Grant Cardone's probably one of the ones we see the most. He's got a really big Reg A fund where people can just put $5,000 in. Because that's another thing, is like a lot of people that self-direct, they gotta have you gotta have $50,000 for a lot of these. Like the minimum investment for a private fund typically is $50,000. But some of these crowdfunding deals or a Reg A fund like Grant Cardone's, like you could do $2,000 if you wanted, you know. That makes it more accessible too.
No, they're game changers, like you said. I think they're gonna definitely grow. I just happen to be invested in that Cardone fund. I think it's been pretty good to me so far.
Oh, so it's been good to you?
Yeah. Oh yeah. So I've actually only had like 1 or 2 bad investments from the Reg CF and Reg A plus space, but I'm very picky as well. So I'm not going into stuff that doesn't have any sort of proven, you know, some sort of numbers associated with it. Like I try to stay away from the pre-revenue stuff and things like that I deem a little more risky. So there's a lot of opportunities though in the space. So
and that Reg CF and Reg A, just so everybody like, some of you may listen to what the hell is that? You know, and that's like this set of securities laws that opened up alternative assets where you don't have to be an accredited investor. You know, and they also are like, it's kind of perfect if you really want to get on earlier stage stuff and you don't want to do the 50,000 minimum. there's been a lot of great companies. I mean, companies that have done really well, that have funded on Reg CF or Reg A. A lot of our clients, ones I've seen that have been popular, there's a lot of like portals, like, there's like Republic and all these other ones. There's even like Real Crowd is one I've worked with quite a bit, where they basically go raise from like private equity firms or VC firms, I should say. And then they come onto the portal and say, hey, if, Andreessen Horowitz invested in this thing, or, or Sequoia invested in us, you would be dumb not to invest in us too early on. Because a lot of people are like, well, how come the VCs can make so much money like Sequoia and Andreessen Horowitz? I can't even invest in their fund if I wanted to. I couldn't go invest into their VC fund as an investor. But the same company coming through later comes and raises on a lot of these platforms. And so a lot of people have used that as a way to look at good deals, to say, well, let me see who's already invested in this. And if they bought in on it, then I know they validated it to some degree. Obviously there's still risk. But I think that's been a smart model. And I've seen a lot of clients kind of do that, kind of the copycat, quite honestly.
Yeah. And on a side note, I'm a little irritated with the SEC that they expanded the definition of accredited investor to include financial advisors that have certain licenses, but not include CPAs. I'm just saying, when the CPA signs the damn audit report for those companies. So
we're attorneys. I feel like, could we not do due diligence as an attorney and like know what the hell we're doing?
Yeah, right.
Exactly. Like, there's other professions out there that are very knowledgeable and astute and should be included as an exception to those rules. So anyways, but I know we're a little bit over on time. I don't know, Eric, did you have any final question for Matt? I know his schedule.
Matt, what are you guys' upcoming conferences? I know I know of two, but I would like for you to share them.
Yes. Yeah, we got two coming up. The Real Estate Tax Summit, which is going to be in Austin, Texas. Ooh. That's one Mark and I do together. That's September 29th-ish. So it's the end of the month in September, but go
29th and 30th.
29th and 30th. There you go. All right. Okay. That's realestatetaxsummit.com. You coming, Eric?
I think I will. I don't know yet. Ignatius,
where are you in Texas?
I'm glad you called him out, because he lives in Austin, Texas.
Oh, you live in Austin.
My office is 10 minutes.
We came there just to make it easy for you.
I know, but I have an unusual travel schedule, so I.
Oh God. Okay.
I don't know yet. I think I can go. I just have to double check a couple of things, but I think I can go during that time.
Okay. All right. Yeah. Fair enough. And then we have the Self-Directed IRA Summit. That's my event. That's kind of like my main event. That's sdirasummit.com.
Yes.
And that's October 20th and 21st. And then we do a golf tournament on October 22nd, which is Saturday. So that's charity focused.
Oh, that's why it's different this year. You moved it.
Yeah.
to
we kicked the golf tournament to Saturday to kind of get more local participation. And also some people don't care about the golf. So some people, that's all they care about. So we tried to make it a little,
I think that one I probably will attend. I'm probably like to do the Austin one, since I don't have to stay in a hotel. But yeah.
So Self-Directed IRA Summit's in Scottsdale, Arizona. And those are the two events we got coming up. Obviously, Real Estate Tax Summit's going to be focused on real estate tax strategies. Self-Directed IRA Summit's self-directed strategies. Other guest speakers, I'll be speaking. Mark Kohler, my partner, will be speaking at both. So it'll be a heck of a good time.
Awesome. Well, thank you, Matt, for joining us today. This has been an awesome episode, talking about some key stuff related to directed IRAs, self-directed IRAs. So again, if everyone's interested in getting involved in this space, feel free to reach out to Matt's team over at Directed IRA. You may not get a hold of him directly, but he has a lot of wonderful people that works for him, and so they'll take care of you. And then also, if you need some advice from a CPA that's familiar with space, we're here for you as well. And if there's anything else that we can do, please let us know. So don't forget to like, subscribe, and comment on the podcast. We always like to hear your feedback from everybody, and we will talk some more with you later. Hope everybody has a good one.